This video is sponsored by Morning Brew. Visit the link in the description below to sign up for their daily newsletter today. The US federal government is at its debt ceiling of 31.46 trillion US dollars, the maximum amount the Treasury is able to borrow in order to meet its financial obligations. Since first hitting the ceiling in January, Janet Yellen, the Treasury Secretary, has been using extraordinary measures to keep the government running. Things like moving cash around or suspending investments in order to prevent a total shutdown. Something that's only expected to last until some point between July and September. If things aren't resolved by then, we could see the US government default on its debt. Something that would likely cost the economy dearly. It all sounds pretty dire, doesn't it? Indeed, a default would be a severe situation for the US. We've seen firsthand how countries like Greece and Sri Lanka can be crippled by missing payments on their debt obligations. But as scary as the headlines might sound, the story is more so one of political discourse than fiscal demise, at least at a surface level. You see, while the debt ceiling is currently impeding the Treasury, it can be hiked at pretty much any time. In fact, it's been hiked by Congress an average of 1.2 times a year since 1960. The only reason they haven't done so this year so far is that Republicans are trying to get spending concessions from the president before voting on an extension. So while I wouldn't completely write off the chance of a default because of political squabbling, you can see that this acute issue does have the potential of being resolved pretty quickly. But it does raise a different, more important question. Isn't the fact that the government keeps needing to push this debt ceiling higher and higher a real problem? After all, it doesn't take an economist to recognize that this is a pretty alarming chart. And it's why some have gone so far as to claim that the US, with its insatiable spending, is headed towards a debt crisis. But while I don't want to understate the risks that do exist here, it is worth recognizing the nuance of this situation, and why even with a massive debt pile, the US is still pretty far away from a Greece or Sri Lanka-like outcome. So let's dive into why US debt is something to be taken seriously, but why a crisis isn't necessarily imminent. Debt ceiling aside, on today's Plain Bagel. It's no surprise that governments spend a lot of money. They are, after all, the single largest entity operating within a country's borders, and outside the salary of their employees, the military, social programs, and infrastructure are all pretty cost-intensive pursuits. The funding for these costs come primarily from taxes, with the single largest source often being individual income tax. But whenever a government spends more than it earns in a given year, they need to borrow the difference. In the US, this is done primarily through the issuance or sale of treasury bonds to individual and institutional investors, both within and outside its borders. So whenever you ask yourself who the US owes all this money to, the answer is sort of everyone, with most of the money being owed to America's own citizens and roughly a quarter being owed to foreign holders. Now, it's worth noting that we're specifically talking about federal debt here, which is distinct from a country's private debt held by its households or corporations. And as with the private sector, debt can be a very handy tool for smoothing out fluctuating revenue and meeting heightened costs during times of turmoil. But the idea that the government will eventually pay back this debt after storm clouds clear isn't really a thesis that's played out very well in the United States. In fact, the US government has reported a budget deficit whereby it's spent more than it's earned every year since 2001. Something that's caused the federal debt balance to rise at an average annual inflation-adjusted pace of 5.7%. It's no wonder then why the US government keeps needing to hike its debt ceiling. And the sort of trend clearly isn't sustainable. But total debt isn't by itself a good gauge of a country's solvency, even if it is adjusted for inflation. The size of a country matters here too. A growing debt balance may not be all that concerning if a country's size is keeping pace regarding its economic output, which is why economists often look more towards a country's debt to GDP when trying to gauge a country's debt burden. So, how has debt to GDP been doing in the US? Well, not so great either. At 124%, this measure is currently the highest level it's been since the end of the Second World War. How did this measure get so out of control? Well, if you chart the ratio over the past couple of decades, you can see that we've seen a jump in debt every time the US has experienced a severe economic shock. The bursting of the dot-com bubble in 2000, the financial crisis of 2008, and more recently, the COVID-19 pandemic of 2020. This makes sense since during downturns, you often do see both a decrease in economic activity and higher government spending, a double whammy to the debt to GDP figure. But this added debt has proven pretty sticky. And historically, debt to GDP hasn't really had a chance to come down before experiencing a new threat. Contributing to this is the fact that from 2015 to 2019, tax revenue collected by the US federal government has actually fallen by 1.2% in real terms. This despite spending continuing to rise in line with GDP growth. And what makes the level of 124% particularly concerning is that it's in line with the levels of debt seen by countries like Greece and Sri Lanka before their own debt crises. That's pretty scary, but doesn't mean that the US is bound for the same fate. Well, there is a real risk here. But before you decide to invest in canned soups, underground shelters, and blue and yellow jumpsuits, it's worth keeping in mind that the US has a number of pretty unique advantages in managing its debt load. For one, it should be obvious that the US economy is fundamentally very different from countries like Greece or Sri Lanka. As the largest economy in the world, the United States enjoys much more industry diversification, access to capital, and a lower reliance on crucial imports like food or energy than even some of its strongest peers. Greece, meanwhile, has had no monetary control over its currency and was grappling with a severe tax evasion problem when it first defaulted on its debt, while Sri Lanka found itself unable to afford critical imports after its tourism industry and the price of the imports were both heavily impacted by the COVID-19 pandemic. Secondly, while inflation in the US has been pretty elevated in 2022, the measure has historically been much more constrained when compared to countries that have experienced similar debt loads, something that's given Congress a lot of spending and borrowing leeway. After all, inflation is its own sort of debt ceiling that a government must grapple with, given that it involves too much money chasing too few goods, and massive jumps in government spending can cause bouts of high inflation, given that it causes a sudden surge of demand within an economy. But the international dominance of the US dollar has helped keep inflation below the double digits, even as the government has enacted record spending packages. Now, it's worth keeping in mind that government stimulus isn't the only factor that can contribute to inflation. We only saw prices start to rise in the US after severe supply chain disruptions from the pandemic. But the US dollar does benefit from a lot of international demand by central banks as a reserve currency, by foreign countries for trade, and even by some investors as a safe haven asset. All of this increases demand for US dollars around the world and helps mitigate inflationary pressures that might come from larger government spending. The US has a lot more flexibility in pushing that boundary given its status globally. Finally, perhaps one of the most important factors to keep in mind when looking at the massive US debt load is interest rates. As you know, many central banks around the world kept their policy rates near zero over the past decade, including the Federal Reserve. This has allowed the US government to significantly decrease its cost of debt. According to the official Treasury website, the government currently has a weighted average interest rate of just 2.07%, well below its historical average. In fact, if you take a ratio of the government's net interest payments and compare it to the government's revenue, you can see that interest payments take up 9.7% of the money the government brings in, which, while on the higher end of the past 2 decades, is actually lower than what it was in the year 2000. This despite debt to GDP being more than twice the amount. Meanwhile, interest payments as a percentage of outlays is much lower than its historical post-Second World War average. In other words, even with a massive debt load, the cost of maintaining this debt is actually lower than it's been in the past. And it goes to show just how much of a boon rock bottom interest rates have been to the US government, and why it's been able to accommodate such a massive debt load. And even as rates are rising, US government borrowing terms remain pretty cushy. While the Federal Reserve has hiked its own federal funds rate by 4.5 percentage points since the beginning of last year, the 10-year US Treasury yield, effectively how much investors are demanding to earn as interest from the US government, is still just around 4%. This remains below pre-2008 levels and signals that there's still plenty of savings willing to park their funds into government bonds. It's also a sign that despite the concerning level of debt, investors, as of yet, don't seem to believe that a debt crisis is inbound. In fact, for those unfamiliar with financial models, the US Treasury yield is often used to represent a risk-free rate of return, showing just how much confidence markets seem to have in America's solvency. Even China, a country that many would argue is America's biggest economic nemesis, holds the second largest balance of US Treasury bonds, behind only Japan. So as much as people might be screaming that a collapse is imminent, the market simply doesn't seem to believe that that's the case. Nonetheless, while some of this might be reassuring, none of this is to say that there isn't a severe problem at hand. Hopefully I've helped to explain why the situation is a bit more nuanced than high borrowing balance equals debt crisis. But the US does have an ever-growing liability that will eventually need to be addressed. With inflation as high as it is, the Federal Reserve may need to continue hiking rates. And if the US government wishes to attract capital from investors, it will need to itself offer higher and higher rates to compete with other borrowers. Higher rates will eventually start eating a larger share of the government's budget pie, which will put the government between a rock and a hard place. If they don't address the burgeoning debt balance, they could run into a debt spiral, needing to continually borrow more and more money until they're tapped out. But austerity measures to reduce the debt balance, while good on paper, could cause irreparable harm and sink the economy into a deep recession if not handled properly. Something that could actually worsen the debt to GDP ratio, like it did in Greece. All the while, the US faces the risk of another economic shock coming along and really screwing things up, especially given how stretched thin things really are. And with the war in Ukraine and the lingering effects of the pandemic, there are a lot of risks at play. So as much as I'd love to say that this isn't something to worry about, the truth is that I can't. We really are in uncharted waters. The US is heavily ingrained into the global economy, and their debt situation matters for those within and outside the country. Even still, on the spectrum of unlimited spending without consequence and imminent collapse, the outcome, as with most things, is likely somewhere in the middle. The risks of a recession, perhaps a painful one, are admittedly high. But the government should see lower spending as the acute headwinds of the COVID-19 pandemic subside. And if the government is able to prioritize managing the debt balance before interest payments see a meaningful uptick, a debt crisis would be avoided. As highlighted with the comparison to Greece and Sri Lanka, there's also a lot more to a debt crisis than the debt load alone. Japan, for example, has actually had a debt to GDP above America's current level since the year 2000, with a current ratio of over 260%. And while that certainly comes with issues, it does show that a high debt to GDP itself doesn't spell an imminent default. And it's impossible to predict how inflation, interest rates, economic output, and the multitude of other factors involved in determining a country's solvency will look further down the road. The cost of insuring against a crisis is also pretty expensive for the individual investor. There's a reason timing the market is considered such a dangerous practice. So I don't want to be blind to these sort of things. It is a little early and quite risky to be banking on the collapse of the world's largest economy. So in my channel's typical non-answer fashion, I can't tell you how the US debt situation will play out. But with interest payments not yet taking an excessive chunk of the government's revenue, there is still time to address it. We just need those in charge to stop bickering long enough to sort it out. Maybe we are in trouble. Today's video was sponsored by Morning Brew. If you like learning about the US debt situation and want other ways to keep up to date on important headlines, you should certainly check them out. Morning Brew is a quick read newsletter that sends out content 7 days a week on tech, finance, and business, helping you keep a pulse on the markets and the world's big happenings. They've had some great coverage of the current debt ceiling situation, including a discussion of the $1 trillion platinum coin, which, if you aren't familiar, is this really weird tactic the Treasury could theoretically use to avert a debt default. And outside of covering interesting topics like this, Morning Brew is just a genuinely enjoyable newsletter with jokes and witty writing spread throughout the stories. They're a really fun read. They're one of the first things I look at every morning. If you'd like to check them out yourself, you can use the link in the description below to sign up. It's completely free and takes less than a minute. So thank you, Morning Brew, and thank you guys for joining me today. I hope you found this video helpful. If you did, please do make sure to like, subscribe, all that good stuff. It does help the channel tremendously. And let me know your thoughts on the US debt situation down below. Thanks again for joining me today, and we'll see you in the next one.